How did Europe go from many currencies to the single euro? Imagine a continent where every country has its own money, making trade and travel complicated. That was Europe many years ago, with dozens of different currencies. Countries often faced fluctuating exchange rates, which made prices unpredictable and hindered economic growth. To fix this, European nations decided to work together more closely. They wanted a shared currency that could promote stability and make trade easier across borders. This idea led to the creation of the European Monetary Union, a group of countries committed to economic integration. The European Central Bank was set up to manage this new currency, the euro, and to keep inflation low and stable. Before adopting the euro, each country had its own central bank and monetary policy, which meant they controlled their own interest rates and money supply. But this caused problems, like currency swings and inflation differences that hurt trade. So, countries agreed to meet specific rules called the Maastricht Treaty in 1992. These rules set limits on inflation, government deficits, debt levels, and exchange rate stability. Countries had to meet these criteria to join the euro. The transition happened in 3 steps. First, nations worked on aligning their economies and policies to meet the Maastricht criteria. This meant controlling inflation and keeping budgets balanced. Next, in 1998, the European Central Bank was created to take over monetary policy for the Eurozone. Its main goal is to keep prices stable by controlling interest rates and money supply. The ECB's focus is to keep inflation around 2% over the medium term. Finally, in 1999, the euro was introduced electronically for banking and financial transactions. In 2002, euro banknotes and coins replaced national currencies in most countries. This move made currency exchange within Europe unnecessary, reducing costs and risks for businesses and travelers. The European Central Bank plays a key role in this system. It sets interest rates and uses other tools to control inflation and support economic growth across all Eurozone countries. By managing the euro's value and keeping inflation low, the ECB helps ensure the currency remains stable. This entire process was designed to create a more connected and stable Europe, where countries could trade more easily and grow together. The shift from many currencies to one was a big step toward economic unity, with the European Central Bank at the heart of maintaining stability and inflation control.